So, good morning, everybody, and welcome to BDO's Share Plans and Incentives webinar, which will examine some of the key challenges and opportunities for companies that operate share plans. I'm Matthew Emms, a tax partner in our Share Plans and Incentives team. There's been a lot going on. We're facing a severe cost of living squeeze, which is not just about inflation. Rising prices are just one part of the squeeze. The other part is about pay and tax changes reducing households' disposable income. There's been a lot said about the causes of the squeeze, but what we're going to focus on in the next hour is ways in which companies are able to utilise some of the tax reliefs that are specifically available to help companies recruit, retain and incentivise their employees in a tax efficient manner during the challenging years ahead. Next slide, please. And next slide. An obvious point, but nothing in the webinar constitutes legal or tax advice, and as such shouldn't be relied on. We have to say that from our compliance team. So just turning to the agenda on the next slide. The mini budget has brought about a raft of tax changes, almost all of which were swiftly scrapped. But a couple of the changes that did survive were aimed at encouraging more listed and unlisted companies to use company share option plans to incentivise their employees in a tax efficient manner. Ian is going to discuss a couple of the proposed positive changes to the legislation and the impact that they may have. In October, HMRC issued some new guidance on the impact of using discretion in EMI schemes. We're of the view that the guidance extends beyond EMI schemes and will apply to all tax-advantaged option and share plans. I will step through some of the key principles of the guidance in the impact for companies operating tax-advantaged share plans. Rachel will then give us an update on growth shares as an alternative to statutory tax-efficient share plans and consider when companies might consider implementing a growth share scheme. Andy's then going to summarise a couple of the other alternatives, namely split interest schemes or JSOPs and partly paid shares, and outline why companies may opt for these types of incentives. Please feel free to post any questions that you may have in the Q&A function on the banner line at the bottom as we go along, and we'll endeavour to answer as many of your questions at the end of the webinar, time permitting. We're going to try a couple of surveys as we go along, the results of which will be immediately visible to you on some of the key themes that we'll be discussing. So please do get ready to participate. As I say try, as the surveys always seem to go wrong when they're live, so of course you'll hear one of us say, it worked when we tried it earlier, so hopefully you won't hear too much of that. Now I'll hand over to Ian Rose, who will explain the proposed changes to the company share option plan legislation. Ian.
Thanks, Matt. Yeah, I'm going to talk about CSOP, Company Share Option Plan, and we're going to go straight into the first survey. So, if your company operates a share option plan, please take part in the survey. And the questions are, is it a CSOP? And if it's not a CSOP, we've got a few reasons. Is it because the limit was too small? Is it because you didn't qualify to grant CSOP options? Or was it because of another reason? So please answer if you operate a share plan. Well, as Matt said, you know, we often say when surveys happen, well, it works okay in the practice, but it looks like nobody has voted or it's not working. So we'll move swiftly on to the changes.
It's working, yeah.
Okay, what are the results, Reese?
I'll end the poll now. If you click on the poll section, Ian, you should see it as well.
Yeah, let's move on to the CSOP and what changes are going to. Oh, hey, here we go. Sorry, right, okay. So about just over a third of you don't operate. Just over a third of you operate a CSOP, which is really good, and it's really interesting that. You know, it was another reason why people don't operate a CSOP. It's probably to do with the cost benefit analysis, but a lot of you said that the £30,000 limit was too small, and we've got some interesting news on that. So if we move on to the next slide, that'd be great. And I can tell you about the forthcoming changes that are coming in from the 6th of April. It's one of the few things, like Matt said, that was in the mini budget that wasn't actually reversed, so that's really good. And the limit has been increased from £30,000 to £60,000. Comes into play on the 6th of April. So those of you who answered that didn't operate a CSOP because of the limit, it's doubling in size, which is really good news. So I'm going to talk about the benefits of a CSOP, but we've got to remind ourselves how are normal options taxed, and the way that standard non-tax advantaged unapproved options are taxed that are basically that when the gain is made when an employee exercises the option, there's an income tax charge, probably pay as you earn, employee nick, employer nick, levies, really tax inefficient and pretty much like paying a cash bonus. So if we move on, I'll tell you how CSOP options are taxed and why they're beneficial. And the reason is that when the option is exercised, there's no income tax, there's no pay as you earn, no NIC. Effectively, the gain is shifted towards capital gains tax when the employee sells the shares. And because capital gains tax is at a lower rate at the moment, there's good tax advantages. Not only is it good for the participant, but the company doesn't have any employer NIC liability either. And furthermore, there's a potential corporation tax deduction for the employing company for the gain that's made. And a final benefit is that often with share plans, you don't really know the value of the shares that you give to employees, whereas under a CSOP, HMRC will agree the value of the shares before the option is granted. So there's a lot of good benefits to a CSOP. There are, of course, some conditions. And the main one is that the exercise price can't be set below the market value of the shares on the date of grant of the option. It's got to be equal to the share price or higher. Also, a company can't be under the control of another company. If you're under the control of another company for a subsidiary, you can't operate a CSOP. And the final one is that the exercise of the option usually has to be more than 3 years from the date of grant of the option. So it's a long-term option to give the tax benefits. So if we move on to the next slide, and I'll tell you what's happening from the 6th of April. The main headline thing is that the limit is being doubled from £30,000 to £60,000. And as we saw from the survey, lots of people got frustrated by the £30,000 limit. So it's being doubled. But just to let everyone know, because it's a misconception that you often see, it's not a limit on the amount of tax efficient gains that can be made. It's a limit on the value of the shares on the date of grant of the option. So now you can have £60,000 worth of shares on the date of grant, but they can grow to whatever price, they can grow to whatever value happens before the date of exercise. It's not a limit on the amount that is tax efficient. And not the headline is what I think is a very important change from the 6th of April, and that is that companies are going to have a lot of flexibility over what class of shares they can use to grant CSOP options over. At the moment, there are very onerous requirements. The two main ones are what we call the employee control test and the open market test. At the moment, before the 6th of April, you can't choose a class of share which doesn't meet either of these conditions. The first, the employee control test, is that class of share, by virtue of employees holding those shares, can control the company. The second test, the alternative, is that actually most of the shares of the class that you use for the CSOP have got to be held by non-employees. Both of those are very difficult to meet where a company has got more than one class of share. And basically, it stops companies at the moment operating CSOPs and creating a new class of share specifically for employees. So that's going to change. So if we move on to the next slide, which companies are going to be interested in CSOPs? Well, first category is quoted companies. Lots of quoted companies already use the CSOP. So what will those companies do? Well, the first thing from the 6th of April is they'll probably want to top up their awards because they'll have been limited by £30,000 and they want to top them up to £60,000. They may need to amend their rules to do so. Of course, there are some quoted companies who don't use CSOP in the past, but now they might want to. It might have been that they didn't use it because the £30,000 was too small. So they might want to redo the maths in the cost benefit analysis on that. And just to say that it's often the case for quoted companies that you don't need shareholder approval to amend a plan to make it more tax efficient. So if a quoted company's got a share plan in place, it can probably put in a CSOP under that plan without shareholder approval, because you're not changing the fundamental economics of the plan, you're just making it more tax efficient. Now, lots of quoted companies operate long-term incentive plans or performance share plans or whatever you want to call it, which deliver free shares to employees. Obviously, that's not an ideal fit for a CSOP because a CSOP needs an exercise price, but it is still possible to fit a CSOP within that regime in order to deliver tax efficiency. So that's quoted companies. And if we move on to the next slide, we'll talk about unquoted companies. So once again, if an unquoted company already has a CSOP, they may want to top up the awards to £60,000 from the 6th of April, and they may need to amend their plan rules to do so. Again, an unquoted company might use options, but might not use the CSOP because the £30,000 limit was too small. So they'll want to redo the cost benefit analysis, and their mind might change and they might introduce a CSOP from the 6th of April. And finally, lots of unquoted companies have preferred to use shares instead of options. You often hear the terms growth shares, management shares, sweet equity to actually give employees shares from day one. A reason behind that is that once you get a share, you should be in capital gains tax. Rachel later on in this session is going to talk about growth shares. But what's really interesting is from the 6th of April, because you can basically pick what shares to use, you will probably be able to design your own class of employee shares or growth shares and use that within a CSOP for the first time. So if we move on to the next slide, to the next category of company, PE-backed companies. Very similar, obviously, to unquoted companies, but PE-backed companies and PE investors usually never had the CSOP on the list of possibilities to use, and that is because of those rules around what class of share can be used, because PE-backed companies found it very frustrating. They couldn't use the management share class because it didn't meet the requirements. Once again, from 6th of April, they might well be able to use a CSOP in the future. So if I just summarize the benefits of CSOP from the 6th of April, is that you can use a management class of share. So that's going to be really flexible. You can design the shares that you use under CSOP for your own objectives. And then just the benefit generally about options, it's much easier to grant options than it is to issue shares. You're not actually issuing the shares, you're not expanding your share capital, you're just giving employees rights to get the shares in the future. And that also means that it's much easier to deal with leavers. So, when an employee leaves a company and they're a shareholder, you more than likely want to get the shares back off them. Whereas if they're just an option holder, the option simply can lapse and disappear in a puff of smoke. So it's much easier to deal with. The other benefits of CSOP are the CT deduction. If employees hold shares outright, the company doesn't get a CT deduction for the growth in value. But if an employee holds an option, such as a CSOP option over a share, then there's this potential corporate tax deduction to be claimed by the employing companies when the option is exercised. And that can really change the maths, because that can be a really good benefit for the company, especially if options are designed to be exit based, i.e. only exercised at exit. This can give a big cash inflow around the time of exit and could be used to negotiate a higher sale price for the company. Another benefit of CSOPs is that I mentioned earlier is that the revenue will agree the value of the shares that you use under a CSOP. Whereas if a company just awards growth shares, management shares, etc. to employees, HMRC will not agree the value. However, under a CSOP wrapper, they will agree the value. And that's really good because it removes a lot of uncertainty for both the employees and for the company. And finally, on management shares, growth shares, and as Rachel explained later, they usually have got a low value, and that means that the £60,000 limit is unlikely to be reached. So that's PE-backed companies. If we move on to the next slide, I'll just mention the other share plan that is around that lots of people will be familiar with, especially smaller companies, and that is the enterprise management incentives, EMI options. They are still the most tax efficient share option, and Matt is going to talk about them, changes to them in the next session. But because the most tax efficient, if you qualify, you will choose EMI options over CSOP options. But lots of companies don't qualify for EMI for various reasons, often because they're too large. So CSOP is still the second choice, but it's so much more flexible and so much more beneficial from the 6th of April coming. So if we move on to the next slide, please, we've got another survey. So I've talked about how CSOPs are going to change from the 6th of April, and we're really interested to find out whether these changes mean that you're likely or more likely to implement a CSOP from the 6th of April, and we'd like to know why. So the options are yes, because of the increased limit. That's the 30,000 going to 60,000. Yes, because it's going to be so much more flexible and you can pick your own special share class for employee incentivization. And the final choice is no, you're still unlikely to implement a CSOP. So if we open the survey, it'd be great if we could get your views on this. Okay, Reese, has any answers come through yet?
Yeah, sorry. So it's all going through now. We're at 50% participated. So
Okay, that's thank you everyone who participated.
I'll share the results now.
Excellent. Thanks, Reese. So just over a third of you aren't likely to implement a CSOP, but that means that the vast majority of you are thinking about implementing CSOP in the future, and it's interesting results here. 40% of you have said that you're more likely to implement a CSOP because of the increased limits, and that's the headline change, the 30,000 going to 60,000. But really interesting also is that a third of you are more likely to implement a CSOP because of the flexibility that's being offered, that you can now pick the share class that you use. So thank you for participating in that. And if we move on to the next slide, I'd like to introduce Matt again, who's going to talk about that other kind of plan, the EMI share options. Thank you.
Yeah, thanks very much, Ian. And yeah, there's a lot of benefits around those two key changes to the CSOPs legislation. So just picking up on the EMI legislation, I think it's fair to say that EMI schemes are the most popular discretionary share option plans in the UK due to the very generous tax breaks available to both the company and employees on exercise of the EMI options and on the resulting sale of the shares acquired. HMRC have stated that over £2.1 billion of income tax relief has been provided on the exercise of EMI options since the scheme was introduced, and just under £1 billion worth of NIC relief. As EMI schemes are discretionary schemes, it's the company's board that selects who participates in the awards as opposed to an all-employee type plan, and therefore EMI options tend to be focused around key management. Therefore, HMRC do take a greater interest in the operation of generous discretionary schemes and how they operate than when the benefit is shared amongst all employees. As EMI schemes will generally last for 10 years and options granted under the scheme can also last for 10 years, then the scheme needs to be flexible enough to deal with any, what I refer to as known unknowns and unknown unknowns, which may arise over the next 20 years. I think of known unknowns, such things as leavers. We know employees are going to leave, but we don't know when or in what circumstances an individual is going to leave. And the sort of unknown unknowns are things that may arise in the future, such as third-party investors. We don't know what form that may take, the impact it will have on the company, or when this may happen. Therefore, boards operating EMI schemes like as much discretion as possible to deal with the unknowns so that they have the flexibility to react to these changing circumstances in a nimble and commercial manner. So I'm going to try a very quick survey as well. And so if your company operates an EMI scheme or CSOP, do the rules contain discretion, which allows the board to change or bring forward the date on exercise? And we'll see what the results are there. And then we'll see then how that impacts about the new guidance that's coming through. Are we okay to release the results there, Riz?
Answers are still coming through.
Okay. All right. Okay, so about a quarter do allow. Okay, so that's quite relevant to what we're going to talk about kind of going forward. If you go to the next slide, please, Riz. Okay, so case law. I know everybody loves a bit of case law, and there are 3 leading cases regards discretion in tax advantage share plans. First case is the Europe copy case, and this case considered amendments which affected when shares may be acquired on the exercise of an approved option. So specifically here, we were dealing with where options remain approved if the exercise period was brought forward from being able to be exercised between years 9 and 10 to between years 6 and 10. It was held that the existing option holders obtained new rights at the point of alteration that they didn't hold before. And Mervyn Davis, the judge in the case, noted that a right to acquire is a right to acquire a specified number of shares at a specified price within a specified time span. And if the time span is altered, the right is altered, and it's no longer the same right. And therefore, in the case, the alteration was effectively treated as the grant of a new option and no tax-efficient option was allowed. The next case, very briefly, is the Reed International case. And this case concerned whether the removal of an exercise and lapse trigger should be considered an amendment to an existing right or the creation of a new and different rights. In the Reed case, it was proposed to remove a right of exercise on a merger, which would also have the effect of triggering the lapse of the option to the extent it was an exercise 6 months later. Here in the case, it was noted that a very minor improvements to the rights of option holders is not sufficient to cause the grant of a new option, but just a variation to the previous right, although the Court of Appeal acknowledged that the question of what constitutes a de minimis improvement is a matter of degree. And then finally, the Burton case. This is a case that concerned whether an amendment to performance conditions attaching to an option granted to and associated with an approved plan would lead to the option's terms being insufficiently clear to constitute a right to acquire shares. The judgment here in Villot stated that the number of shares to which an employee may acquire upon an exercise of an option could be governed by conditions imposed or varied in good faith after the option was granted. So it didn't matter that the directors, the case really focused around it, said you couldn't have unlimited discretion. However, an alteration or variation at a later date would need to be done, first of all, in good faith, and also to ensure the effectiveness of the scheme. And therefore, as a result of this case, HMRC do not generally comment on amendments to performance conditions. And again, this is covered in the new guidance. So on the next slide, we'll see some typical discretions that we see in schemes. They are very varied, and this is just a very small selection of those. Now, if we just turn to the next slide, which deals with the revenue's new 4 key principles. And there's the reference there to the revenues manuals there if you wanted to have a look at the guidance themselves. So the first key principle is that provided it's sufficiently clear in what circumstances and when an option is capable of exercise from the outset, the exercise of discretion to accelerate the vesting or vary or waive any performance condition is acceptable, provided that the effect of the exercise of the discretion doesn't bring forward the point on which the option is able to be exercised. Okay, and some of these key principles we'll look and see how it works then in practical examples. HMRC will not generally take issue with varying or waiving on a fair and reasonable basis and question what that means, and also in appropriate circumstances, a little bit vague, performance conditions. So they won't take issue with that. The third one is something that is a key change really in the new guidance, that the revenue is saying it's not acceptable for an option to become exercisable in circumstances where the board has complete discretion to choose the circumstances under which an option may be exercised. And we'll come back and look at this in a practical example. And then finally, if we can just move through to the next slide there, on the key principles. It's not acceptable to amend an option agreement or rules or use discretion to create a new right of exercise, introduce discretion where none existed before, or to change the date of exercise unless the amendment does not involve the improvement of the rights of the option holder, which is more than de minimis. The guidance itself that the revenue have issued is sort of over 10 pages long with lots of examples, which some of them are helpful, some of them less so, because they just play through the actual specific guidance that the revenue has given. So it's the bits around the outside, the edge of it, that we are always interested in. So if we just move to the next slide. So if we look at what the EMI legislation states, basically the revenue say here, and the legislation gives three fundamental terms of an EMI option. And that is the number of shares that may be acquired, the price at which you acquire them, and the when you can exercise your option. Those are our three fundamental terms, and the revenue is saying you can't change any of those. You just can't. But HMRC do draw a distinction between these three fundamental terms and other conditions, such as performance conditions or potentially vesting conditions, which affect an individual's entitlement. So let's look at the three cases here. So the first is the exit-based EMI scheme. So here, in an exit-based scheme, the when can an option be exercised? Well, that will normally be on the relevant corporate event that triggers the right of exercise. So typically here, we're thinking about a change of control in whatever form that may take. So can the EMI plan have discretion in relation to accelerated vesting? Well, what the guidance tells us is that you can accelerate vesting on a change of control, provided that there is discretion that is within the rules and it's exercised on a fair and reasonable basis. So that's what the revenue tell us. Can you amend the performance or waive performance conditions on a change of control? Again, HMRC is saying that they treat the performance conditions and any other conditions as not part of these three fundamental terms, and therefore we should be able to amend or waive the performance conditions provided there is a specific discretion to do so. So the exit-based plans are less contentious. If we move to the next slide, please. Time-based vesting. So with time-based vesting, we have kind of two different types of time-based vesting. We have options which can be exercised as and when they are vested, and we have options which vest over a period but only can be exercised once fully vested. So in the first example, you might have options which vest 20% each year, and you can exercise each 20% each year, or you can wait until the end and exercise them all. And in the last one, it would be if they're fully vested, vest 20% each year, but you only exercise on the 5th anniversary. So can you amend the vesting schedule? Well, yes, provided it doesn't change when the option can be exercised. For example, in the example I just gave, an option vests 20% each year for 5 years, and it can only be exercised when it's fully vested. The guidance tells us that the board could amend the vesting schedule so that, for example, 60% vests on the first year and 10% in the remaining 4 years. So although we've amended the vesting schedule, when the option can be exercised hasn't changed. But if the option can be exercised as soon as it vests, then changing the vesting schedule would be an issue, because you would be bringing forward and allowing early exercise of a proportion of the option which wouldn't otherwise been able to be exercised. That would be an issue and would be treated as the grant of a new option. So you need to be really careful there. So accelerated vesting will again depend on whether we're bringing forward the when. Amending and waiving the performance conditions is exactly the same as we just talked about. You can, providing you've got discretion. So going on to levers. So levers, again, it's pretty clear normally in most schemes when you can exercise. It's normally at the point of the cessation, and you can normally exercise for a certain period. Normally with EMI options, you say you can exercise for 90 days because that's that period where you can have a disqualifying event and still get your favourable tax. So it's normally clear the when. Can you accelerate vesting? Yes, on the same principles we just talked. Can you amend or waive the performance conditions? Again, yes. So that is normally fine on levers. So moving to the next slide. So one of the things we really need to be careful about is where you have additional discretion. So if you say that an option can be exercised on the early of the following events: a corporate transaction, a lever event, or any other time when the board so determines. Now this clause is an issue. The fact that the plan has it is not an issue based on the revenues guidance, but if the board allows exercise of an option pursuant to it, then the option would be treated as the grant of a new option based on the guidance and therefore taxed as if it's unapproved. So companies need to be really careful when they have these provisions and take professional advice as to how they deal with a change in the guidance from HMRC. So one final survey, Reese, if we can go into that one. Do you think HMRC's new guidance means that the exercise of discretion, so this really focuses on the 25% that they felt that there was discretion within the rules, which allow the board to bring forward the date on which the exercise would work? Do you think that's now an issue within your rules? Okay, giving a few more seconds just for all the results to come in. And I think this is a bit of a common issue that's out in the market, so it's you will not be alone if you are thinking that there is an issue here. Are we good to release that now, Rose? Okay, so about 20%, and 50, just over half, are not quite sure. So I guess you'd need to look at the rules themselves. Okay, so I guess next slide. The key takeaway really is we strongly recommend that you do look at your CSOP and EMI plan, review them to see if they are compliant and in line with the new guidance. If they're not, you should take some advice to deal with the non-compliant terms. Our share plans and incentives team can review your plans and see if they are compliant, even if we didn't implement them. So now I'll hand over to Rachel Tucker, who will discuss one of the alternatives to the statutory tax efficient share plans. Rachel.
Great, thank you, Matthew. So I'm going to give an overview of how growth shares work and how they can interrelate to EMI and CSOP, which Matthew and Ian have talked about. So growth shares are a tax efficient incentive which involves giving employees shares in the company they work for or a company within the wider group. And it's intended to give a capital gains tax outcome. The shares used for the growth shares will be a new class with specific economic rights. So the growth shareholders participate in a proportion of the growth in the value of the company above a hurdle on a future liquidity event, such as the sale of the company. It can be an attractive alternative where a company doesn't qualify for EMI or CSOP, as it does offer tax efficiency and is extremely flexible. And even where a company does qualify for EMI or CSOP, it may be preferable to use growth shares. So for instance, if it's commercially desirable for management to be actual shareholders and have skin in the game. Interestingly, a combined approach is also available, whereby EMI options can be granted over growth shares. And from 6th of April 2023, it should also be possible to grant CSOP options over growth shares. And this is due to the proposed lifting of restrictions on the share classes that can be used for CSOP options, which Ian took us through earlier. So by combining the two approaches, that is having EMI options or CSOP options granted over growth shares, you have the benefits of a tax advantaged option. So no upfront costs to participants, easier to deal with levers, the ability to agree a value with HMRC upfront and potentially no tax at exercise, plus the benefits of a growth share, which I'll highlight. The hurdle which applies to the growth shares is usually set at a specified percentage above the current value of the company. So this preserves current value for existing shareholders. And there are no value caps on the amount of growth shares that can be acquired. Now that's obviously if growth shares are just acquired in their own right. if they're granted under EMI or CSOP options, then the normal rules around value limits on those options would apply. So taking a very simple example as to how growth shares work and how the hurdle applies, say a company is worth £10 million today, and the hurdle could be set at 12 million, and the growth shareholders have a right to participate in 15% of the value above the hurdle. When the company is sold, its value exceeds the hurdle, and so the growth shareholders receive 15% of all proceeds above £12 million. Now that's just an illustrative example. There's a great deal of flexibility around growth shares, so hurdles can be set at wherever is commercially appropriate, and I'll come on to that. The use of a hurdle means the growth shares have a lower upfront value than ordinary shares. Therefore, it's quite attractive because it's cheaper for employees to sort of buy in and participate in the scheme as compared to if they were to get ordinary shares. Now, any amount by which the upfront value of the growth shares exceeds the price paid by the employee will be subject to employment income tax at acquisition. It's important to determine the value of the growth shares upfront so that it's known how much the employees will need to pay or how much will be subject to income tax and potentially nick upfront. But it's not possible to agree this value with HMRC unless the growth shares are going to be subject to EMI or CSOP options. And this is the benefit I mentioned. If you use growth shares in conjunction with either of these option schemes, then you can have that certainty around the valuation up front because there's a facility to agree it with HMRC. When the growth shares are sold, all growth in their value above their upfront value should be taxed as a capital gain, which is at lower rates than employment income tax, and therefore makes it a very attractive proposition. As I've alluded to, the arrangement is extremely flexible. So the hurdle can be set at a level that is appropriate for the business, and the share class can have whatever voting rights, dividend rights, leaver provisions, and rights to proceeds as are commercially desirable. And the growth shares can also participate as a class over whatever percentage of the growth in value above the hurdle as is agreed between the parties when it's set up. So in my example, I talked about 15%, but that was just illustrative. It can be whatever percentage is commercially desirable. In terms of who they're suitable for, growth shares can be used by private companies across all sectors, including private equity-backed businesses. They tend not to be viable for listed companies as there are restrictions on creating additional share classes. However, it is possible to issue growth shares in subsidiary companies of some listed entities. If you're going to use EMI or CSOP options over growth shares, then the usual qualifying conditions for EMI or CSOP will apply. I'm now going to hand over to Andy, who's going to talk about split interest schemes and partly paid shares.
Thank you, Rachel. Yeah, I'm going to paint I'd say the final part of our jigsaw of different incentive plans that we would generally talk to our clients about. So Matthew and Ian have talked about the HMRC tax advantage plans, and Rachel has talked about growth shares. So the final two I'm going to talk about start with the JSOP, or the Joint Share Ownership Plan. If we go on to the next slide, Reese, if we could. This slide is a probably overly complex diagram showing how the JSOP works, and I haven't got time, and I'm not sure you thank me for stepping through all of the different elements of this, but I guess it shows the complexity of the arrangement, and a key factor of this arrangement, which does come out in the structure, is that the employees acquire a joint ownership of shares with an employee benefit trust. So the joint ownership could be perhaps best compared to a husband and wife jointly owning a house. So you can jointly own assets, whereas when a husband and wife jointly own a house, they essentially have 50% of the ownership, and if you sell it, you split the proceeds 50%, which almost is like a vertical line down the middle of the house. With the joint ownership plan relating to shares, you actually have a horizontal line in terms of splitting the ownership of the shares, where the EBT owns all of the shares up to the hurdle, and the employee owns all of the share above the hurdle. And you can hopefully, I guess, hear the resonance with growth shares here, because the economics are broadly identical to that which Rachel has described for growth shares, where the employee acquires an interest in the asset over and above the hurdle. And the tax treatment reflects that which would apply for growth shares. So when you acquire your share, it needs to be valued. And if you pay less than that valuation, then you will pay income tax on any excess. Hopefully that value will be relatively low, so you will either pay a small amount for your interest or pay a small amount of tax. And then when the share is sold, hopefully for a value that is well above the hurdle, then the employee's interest gives them the share of the proceeds that represents that above the hurdle, and that would be a capital gain. So the economics fully reflects that which Rachel has explained for growth shares, and so does the tax. So it is very similar to growth shares. Why would you do the JSOP over growth shares? Well, I guess the first point is that it's much closer to a traditional share plan. So it doesn't go into articles and create share classes and sort of change the company's constitutional documents. Rather, it will likely have a set of scheme rules, and you have an employee benefit trust, and the employee leaves and they just lose their interest. So it is much more like a traditional share plan in the way that it's constituted. And another point here is that when we talked about growth shares, if you want to have a second or a third grant as the value of the business is increasing, you will find yourself having to create new share classes, and so a company's articles can get complex. For the JSOP, you just change your documents in a similar way to the way that you would for a set of. So there's pros and cons, as you can see in the sort of the trade-off between growth shares and the JSOP, but there are advantages of the JSOP, and there are reasons that companies may choose a JSOP over growth shares. If we could go on to the next slide, please, Reese, and I will talk a little bit about partly paid shares. So there you go, perfect, thank you. So partly paid shares can be done over other share classes. So it is a technique that you might combine with the growth shares that Rachel spoke about. But at its most simple, you would expect to use ordinary shares when you're looking at partly paid shares. And the way that it works is that you issue those shares to the employee, and the employee agrees to pay the full value for those ordinary shares. And so often the thing that is prohibited or prohibitive around that approach is that employees don't have the ready cash to pay a significant amount of money for ordinary shares, but the partly paid shares works on a buy now, pay later type of approach. So you get the shares now, you have committed to pay the full value for them, but in practice you won't be required to hand over the cash until you sell the shares, and then you can take your purchase price out of the proceeds. So there's no tax leakage on acquisition because you're paying the full value for the shares, and then you're a shareholder and you will get capital gains tax on the growth in value. So it's quite a neat way of managing the cash flow of people acquiring shares and paying full value for them and getting the benefits of capital gains tax. One of the points here is I guess around valuation and risk. So the individual does, once they've acquired the shares and they've committed to pay the purchase price, if the value of the shares was to fall, then they've still committed to pay that purchase price. And that is one of the reasons that partly paid shares may seem unattractive to people. So some clients may think, well, actually, I'd like employees to feel that they've got something on the line, some skin in the game, and feel that actually they're really truly invested in the business. But there are others who wouldn't want to put employees in a position that says if the value of the shares goes down, then they might be on the line to pay either a purchase price, or if we wrote that purchase price off, they would pay the tax on that write-off. So there is real risk to the employees. I guess the second point around partly paid shares is that there is some detail around the tax treatment. So effectively, the individual is receiving a loan to acquire the shares at day one, and that loan could be a benefit in kind, which generally isn't prohibitive on people operating the scheme, because you may, there are various reliefs around the benefit in kind, and in practice, the benefit in kind is normally a pretty small cost, but it certainly adds some complexity if you're trying to sell this to your participants. The final point around partly paid shares, which again is probably, I don't have the time to fully explain it, but if you go into partly paid shares and compare it to the JSOP or the growth shares, generally the sort of the hurdle that represents the amount that you pay will, because of the way that valuation works, will come out lower than your hurdle under a growth share arrangement or a JSOP, which means that if you were to compare the two, with sort of all the other parameters being the same, the employee would make more gain within capital gains tax under partly paid shares than they would under the JSOP or the growth shares. So that's a bit of a statement that I say it takes a bit of explaining. So that's one of those where you, I guess, you have to take my word for it, that partly paid shares can be more generous than growth shares or JSOP. So that's a very high level overview. But if I think I will now pass back to Matthew, and we'll look at some Q&A.
Yeah, thanks very much, Andy. So I guess, look, what's clear there is there was a lot of material there. It's a real canter through all of that. Actually, each one of those could probably be a session on its own. So we've had some questions, actually quite a few of them. Rachel has been busy answering quite a few of them as they've come in, so I've just seen. But we've got another question there, which is actually for Ian. So you talk about CSOPs being tax efficient after 3 years. Does this mean that they are not tax efficient within 3 years? Ian, do you want to give us your view in relation to that?
Yeah, sure. Yeah, that's quite an interesting one. So yeah, I did say it's usually after 3 years that they're tax efficient, but there are reasons in the first 3 years where you can get tax efficiency, because effectively the revenue put in the legislation, specific reasons, a lot of them are good lever reasons, but it's not just a case of the legislation saying you can be tax efficient within 3 years. Your CSOP plan rules and your option documentation have actually got to list out these provisions in there. So what are the reasons that you can be tax efficient within 3 years? Just looking at the legislation here, first of all, you've got a set of good lever rules. If somebody leaves because through injury, disability, redundancy, retirement, the company that they're working for being sold out the group, or the business being sold and they've got a 2P transfer, then if that happens within the first 3 years, and if it's in the plan rules, then you can have a tax efficient exercise of a CSOP option. But more importantly, often these CSOP rules are designed so that they're exit based, that people can't actually exercise the option until there's a takeover. Once there's a takeover within the first 3 years, well, again, if it's in your plan rules, the legislation provides for it, but there are some requirements. It can be a takeover offer. It can be a general offer. So you've got to decide, you've got to get some legal advice as to whether the change control is a general offer or not. But then really importantly, the option holder can only receive cash on these takeovers. There can't be any rollovers or receiving shares in the new acquiring company, etc. It's got to be a cash only offer for these option holders. So plenty of ways that CSOPs can be exercised within the first 3 years tax efficiently, but you've got to take advice as to whether you fall within the legislative requirements.
Yeah, thanks very much, Ian. That's really clear. So a couple of questions actually for Andy. So the first one is, are JSOPs and partly paid shares widely used? Haven't heard them before. And the other question was, do many listed companies operate JSOPs? So
Great. So yes, I guess is the answer to the first question around, are they widely used? Not as widely used as growth shares, and partly paid shares do have some legal limitations for PLCs. So They're more commonly used in the private company arena, but we certainly have a reasonable number of clients who have kind of looked at the menu of choices and the pros and cons and agreed that partly paid shares is the best route for them. So the answer is they are fairly widely used. JSOP are probably less in vogue than they used to be, but there's no particular legislative reason for that. There's nothing that's really changed. They did used to be more commonly used, and growth shares have become more popular than the JSOP. But again, we are implementing them for clients, and so they certainly, you know, they're not just a concept that don't get used. They absolutely are out there. That plays a little bit into the second question that Matthew just posed, which is, what about listed companies? Growth shares are harder to implement for a listed company because it's much less common and more challenging for a company to have a separate class of listed shares. And so you either have to sort of address that in the listed parent, or potentially look at a subsidiary company, all of which have their challenges with shareholders. Whereas the JSOP uses ordinary shares and a trust, so there's no creation of new share classes. So when you're talking about a listed company, actually the JSOP has further advantages over and above those which I set out when I spoke. And so yeah, you can absolutely do JSOP in a listed company, and it arguably is the most attractive answer after EMI and CSOP.
Yeah, thanks, Andy. And we've certainly seen a few AIM-listed businesses that do have JSOPs in place. So we've got another question here which relates to the EMI discretion. So the question is, we have employees who leave the company, then sometimes the board decide that they can still hold their options until a liquidity event occurs. Usually leavers can only exercise 90 days in the plan rules, but this may then be different due to board discretion. Does this mean they lose the tax benefits due to board discretion? I think this will really come down to the nature of the board discretion. Do the terms within the rules allow the board to extend the period over which the options are exercised? Is that sort of baked into the rules from the outset? If there is, then that may be okay. If it's not, then actually you'd be extending something or extending a right which wasn't there before. So I think you need to be very careful about this, and this is quite common where companies do try to allow leavers to retain their EMI option, even though actually after 90 days after they've left, that will be a disqualifying event and will have tax implications anyway for all growth going forward from the 90-day point. But that's something you just need to look at around that discretionary piece, and what is the terms of the discretions, and is it being exercised in a fair and reasonable manner, and or whether should employees be able to exercise within that 90-day period. So I think it comes down to the actual clause itself. I've got a question around growth shares. So the growth shares is, do growth shares have any value given that there is a hurdle? Rachel, what's your view on that?
Sure, thanks, Matthew. So we do get asked this a lot because intuitively you would think, well, there's a hurdle on the growth shares. They're not currently in the money, therefore how could they possibly have value today? And the answer is that normally growth shares will still have some value up front, albeit only a low hope value, because there's a specific valuation methodology that's used for growth shares, where you essentially look at, based on the company's forecasts, how much they might get on this future liquidity event, and then discount back to take into account risk, uncertainty, and so on, to give you some value up front. Because the logic is, well, surely they must have some hope value, because otherwise, why would you want them if there's no chance that they will ever pay out? So that's why we always recommend evaluation, so that you work out what that upfront value is, you know, however small that may be, and therefore you can say to the growth shareholders, either you pay this amount up front and therefore there's no income tax or NIC when you get your growth shares, or you pay less than that amount and therefore there is some income tax and potentially NIC up front on that discount. But hopefully either way, that cost to the growth shareholders is manageable and therefore it still makes it an attractive scheme. Or you can do what Andy said and combine it with a partly paid approach and you defer that purchase price until a later date. So as you can see, it is pretty flexible in terms of how you manage the upfront cost. I think, Matthew, it could also be worth me just touching on the CSOP limits. We did have a couple of questions on that, which I did answer in the chat box, but in case people didn't see and it's helpful to the wider group, we had questions on how does the CSOP 60 grand limit work, and the answer to that is it's a per employee limit and it's a sort of an all-time limit, so looking at all the options that employee holds, whether they're vested or unvested.
Yeah, and valued at the point that the option is granted. So yeah, so if they do grow in value, you don't take into account in that limit or the increase in value. Okay, look, so I think we've answered pretty much most of the questions that have come in. So I think just on behalf of all of our speakers, Andy Goodman, Rachel, Ian, we just wanted to say thank you very much for attending, and to obviously get in touch if you have any questions. You've got all of our contact details at the back of the slides. We will circulate the recording and the slides so you can watch it back if you have any points that you didn't quite capture, together with our contact details. And otherwise, wishing you a very happy Christmas and New Year. Thanks very much. Bye-bye.